Welcome, everyone, and thank you for attending today's webinar. I'm David Shaw, the Publishing Director for Family Business Magazine. I hope you and your families are all well and enjoying the start of the warming season. Today's webinar is the first in a four-part series of sessions that will take a deep dive into mastering liquidity strategy, from understanding when and why different liquidity options make sense to structuring solutions that fuel both business growth and family office development. But before we get started, a few quick housekeeping details. Let me get this up. So for today, we welcome your questions and especially your thoughts and comments throughout the session. I'll be managing those. Use that Ask a Question bar underneath where you see the slide. We'll go for no more than 30 minutes today and get to as many questions and comments as we can. Now, this is the third in a series of webinars that we've done with Interchange Capital Partners, Ami and Brian Baum, who have undergone their own generational transition and have used their experiences to inform the content of these sessions. As Brian pointed out before we started, this is the ninth in the series, the ninth webinar. Each series is 4 webinars. Son Brian is now CEO and president of Interchange Capital Partners, and his father, Ami, has stepped away from day-to-day operations to assume the role of executive chairman. But I do want to note they've lived what they're talking about, and that's what makes these sessions so compelling. So welcome, Ami and Brian. Great to have you here. I will be back here. Yeah, I will be back with questions as they come up. So
great. That was great. Thank you, David. Appreciate it. So as David mentioned, my name is Brian Baum. I'm the CEO and president of Interchange Capital Partners. What we specialize in is the life cycle of transition of ownership before, during, and after. From a before perspective, we're really focused on the business advisory and the family advisory. The during is really where the liquidity and the structuring comes into play. And the after is the development of a family office, cash flow, and a private wealth strategy for the exiting generations. Ami, do you want to talk a little bit about the Clarity Foundation that sets the framework for how we move through a process?
Yes, and so for those who have been with us before, it's always good to repeat this because it's always part of the biggest challenge. When there are issues in business, in families, in ownership, because we're all very successful, we know how to move into action and get it solved. The problem comes in that sometimes we're not real clear on what needs to be solved. And that's where the Clarity Foundation was developed. We need to begin to recognize that we're working in 4 interchanges. The interchange of ourselves, our family, our business, and our ownership. And it's very challenging to get the clarity depending upon which one of these areas you're actually working in. And so the first step is getting clear vision of what you would like to see happen in the future. Once you build out that bigger future, not only for yourself, but for your family members, the other stakeholders, your ownership, then you can begin to recognize where the gaps are, because there's always going to be some gaps in the understanding of what's going to be necessary to ultimately move into action. And so in that understanding portion, it's not just getting education, it's actually building out structures and testing them and modeling them in different types of scenarios around, well, if we go down this road with a liquidity solution, what does that mean? If we go down this other road, et cetera. So we're doing a lot of, quote, scientific work behind the scenes to make sure that you've got, if I go plan A, plan B, and plan C. And so that in and of itself is a really good structure, but we found over the years that that didn't solve the entire problem. Because now the families, and they can get clarity and they get some understanding, and then all of a sudden it stops because there's no action plan. And so building out an appropriate action plan over years, months, weeks, whatever the case may be, is a critical component to our Clarity Foundation.
So getting into the meat of today. So here's a question that every family business owner eventually faces. When is the right time to take chips off the table? How do you know if you're leaving value behind or if you're locking it in? So if you ever stared at a balance sheet that looks great on paper while wondering why your personal financial security feels uncertain, or you've had conversations with family members who disagree on whether to extract the cash or double down on growth, you're really not alone. In fact, Ami and I had that conversation 2 days ago. You guys can think about where both of us were on that spectrum. The tension between liquidity and reinvestment is one of the defining decisions of owning a business. And most owners look at liquidity in a binary term, whether I sell or whether I hold. And there's really no optionality between those two. The reality is it's way more nuanced. And I'd like you by the end of this to start thinking of liquidity the same way you would think about business strategy. There's multiple ways to unlock it, but you have to know what your ultimate goals are to see what options you have available today versus what you could have available in the future. So today we're going to unpack 3 key areas. First, how do you read 4 key signals that indicate when it's the right time to pursue liquidity? What the full spectrum of options actually looks like, and then how do I evaluate the cost of doing nothing versus building and developing an active liquidity strategy for the business and the family. Ami, you want to start with reading the signals?
Yeah, so liquidity timing isn't about catching that perfect moment, obviously, but it's about recognizing when multiple signals align. And there's 4 categories that you see on the screen that every business owner has to monitor. So let's talk about the first one, which is market conditions. Clearly, valuation multiples and the buyer appetite for your sector is a variable. There are certain businesses that are very hot right now, and there's businesses that aren't. So understanding and knowing what your valuation multiples are and what the marketplace looks like from a buyer appetite is critical. The interest rate environment, it affects all kinds of areas of liquidity, from deal financing and buyer leverage, and then the notion of the type of buyer that's out there. Are there strategic buyers that are looking at your industry? Are there private equity buyers that are very active in your industry? And then what's going on in the general merger and acquisition trends as it relates to the deals that are getting done? And so it's pretty clear that through our experience, we have seen many people who have missed the mark because they didn't have a liquidity strategy and the market was ripe, but they weren't ready. And they said, oh, we have some time. And by the time they got ready, the market had changed dramatically. And those are not isolated instances. Again, a lot of the work that we have recognized is not a function of that business owners aren't successful. It's that business owners don't necessarily design structures to be able to identify where the stress points are going to show up. This is not a storyline of if it's going to happen. This is when. Liquidity events is a when, not an if. Obviously, there's business life cycle stages. Where are you in your life cycle? Are you a growing trajectory? Is your business in an acceleration mode, or is it in a plateauing phase? And part of the issue for certainly significant generational families is the notion of growth trajectory. We see a number of businesses where the growth is behind them, and yet the generations are growing, and that creates some tension. Very candidly, management depth. Can the business operate without the current generation? And in many cases, that answer is, no, we really haven't done that. These are all the steps that you have to look at. What about capital requirements? you're in a situation today, and we see it obviously in AI, where the capital requirements are off the charts. Companies are turning around and changing pathways all the time because the capital that's necessary to be able to do what they need to do is there. So as the capital intensivity of your business, what does that look like? And then your revenue concentration risk. Is value concentrated in only a few relationships? Or these are the kinds of things that you have to address from a business life cycle stage. And again, what happens is a liquidity event shows itself, and then you go through and look at all of these business life cycle stages, and you're not prepared. And the whole purpose of these conversations is to recognize liquidity events are going to take place and start setting up structures and designs so that you can make appropriate decisions around that. We can't forget about family, the needs and the readiness when it comes to the family. And this is where a lot of it, you can work on those other two pieces because they're outside, and Brian and I know this story very well. And when it comes into the family, things just go in many different directions. Because we're different. Obviously, we're different generations. We have different needs. We have all kinds of different objectives. But one of the first things we had to do, and certainly I had to do it because I'm a founding generation, is the next generation ready and willing to operate the business? And frankly, 15 years ago, the answer was no, until Brian raised his hand and said, I might be interested. Well, if you're interested, and then we set a very deliberate plan of action so that Brian could get success and build and grow into this. But this is, again, not just the founding generation. It gets even more complicated. And for those multi-generational families on the call, you know it better than anyone that when you have multiple generations and you have people who are in the business versus out of the business, it even gets more challenging.
And I think that this family section really is the biggest signal to listen to, because one of the things that you and I had to come to terms with is, how do I have to run and operate the business because of your liquidity requirements? It forced different constraints that if you weren't in the picture, I may not have right now, but we needed to know what those were because that directly impacted how the business needed to operate.
Right. And it's a continual conversation and development because I'm not getting any younger and he is. So therefore, we have this, constant tension that's there around that. But when you talk about family alignment, are the key stakeholders, do they share a common vision for the future? And this goes back to the clarity. That clarity portion of the work is making sure that everybody is in line with their vision. And it's okay that their visions are different. It's really important. When people talk about alignment or vision, people say, oh, kumbaya, we're all going to agree to do it this way. That's not how alignment operates. The way alignment operates is everyone gets an opportunity to talk about where they want to be, what their future looks like, what their strengths are, what they see as opportunities out there, what their obstacles are. And then that is open in a space to be able to create that alignment that's going to be necessary. And then obviously there's liquidity events that happen in family life. There's all kinds of things. Life is fragile. Everybody knows that. So the obvious ones, death, disability, but there are more things than that. There's lifestyle changes. There's all kinds of things around the family life. And then one of the largest things, which a lot of business owners, myself included, forget, and that is diversification. How concentrated is your total wealth in the business? I'm like most founders, the bulk of my wealth is tied up with the Interchange Capital Partners.
And we do this for a living.
I'm sorry?
And we do this for a living.
And we do this for a living. So you can imagine that we understand and we know, and we are working towards it. But that's an important signal, the family needs and the readiness. And then, of course, the whole idea of the tax environment. And the one thing we know, there's death and taxes, but the other thing we know is they change all the time. And so, the capital gains rate environment, from where it is today versus historical. So again, when you look at liquidity, there is a misnomer that the only way you can create liquidity is to sell. And we're going to talk a little bit more about that later on in the webinar. But it is an important consideration, obviously, the tax environment. The estate tax exemption levels, well, we got a break. Everybody was rushing to do all the work last year in anticipation of, the estate taxes not being extended. They subsequently have. So we've got that as no longer as a headwind and more of a tailwind for us. And now there's some other opportunities of this to be able to work with tax mitigation strategies, opportunity zones, installment sales, other kinds of deferral mechanisms, qualified small business stock. But if you've been paying attention to this stuff, and some of you have, and most of you probably haven't, because when it comes to taxes, you wait till the 15th and, you get your tax prepared. There isn't a lot, unfortunately, of tax planning that you're doing. I will tell you that the greatest tax opportunities, the stronger they get, the more attractive they become to you and your family and your business, they show up as a red flag for the government and the IRS. And so things like QSBS, great strategy, was off the radar. It's on the radar now. And so there's already some talk and discussions and legislative groups about, well, what are we going to do about this and kinds of things. So the tax environment is an ongoing issue as well. So you have to be able to read the signals, and those signals will inform you. But the problem is, if all you're doing is going about running your business and running your life, and you don't have any kind of structure around liquidity, thoughtful liquidity solutions, then you are reactive rather than proactive. And we want to put you into a position so that you can be proactive in this liquidity. Brian?
So moving on to some of the liquidity options and what that spectrum really looks like. And as I mentioned, it's not binary. There's an entire spectrum of strategies that really exist. And the right answer depends on which of the signals are most prominent for you and your family and your business, but also what timeline they need to exist in. If you have a dire liquidity need, then you may only have the options that are open today, and you may not have the time to build to open up future liquidity options. So a couple of them that you probably know about: whole exit, strategic or financial buyer, partials or a minority recapitalization, although you have to be a very, very large business for any minority equity player to be interested. So that normally is actually off the table. There's multiple different recapitalizations, and some really creative ones that we've seen and helped develop are when you start playing with different preferred units within the operating agreement, where maybe one generation gets a larger preferred distribution, and in exchange, they are giving something up to younger generations. So there are ways to work within shareholder agreements, operating agreements, just from a cash flow perspective on dividends that are going out, to right size it in moments in time. Reviewing dividend policies or distribution strategies, figuring out how much leverage you could potentially put on your balance sheet. For example, we lived through about 10, 15 years of interest rates sitting at next to nothing. And a lot of you probably had pretty healthy balance sheets at that time. Had you done a dividend recap, even in, I'll call it 2020 right now, you would be sitting with a really, really low interest rate, and you would be paying that off probably very easily at this moment. But again, you got to know why you are doing this to enact some of those strategies. So if those are the ones that are available today, what are some that you might need to build towards? Well, this is where you start looking at some hybrid strategies and think about liquidity from a roadmap. So maybe today I only have a dividend strategy. That's the only liquidity that our owners get. Maybe tomorrow I need a bigger lump sum for people, but I don't really know where to get it. Maybe I sell a partial amount of the company to an employee stock ownership plan, not the whole thing, but maybe a part of it. Maybe I build out a future, deferred comp structure for some of the family members that are working in the business. So you're kicking the can down the road, but you're also getting them more invested today. You can look at things like management buyouts or some other tax advantageous strategies. One that I think puts a lot of family members in the driver's seat versus a reactive mode is, what's the corporate life insurance strategy? If death and taxes are certain, then we're missing one liquidity event that we know for sure is going to happen. And there are things that have been developed that allows companies to own the insurance and turn it into a cash positive versus just a cash negative whenever you structure it properly. But all of these take time to understand, to build, and sometimes the company has to evolve to where some of these doors are even open. And frankly, even some of the main options may not be available due to too much debt on the balance sheet, too much risk from a revenue perspective with customers. So the way that we start figuring this out to determine what the present versus future availability is we're really looking at what are some of the key factors that determines that mix. So of course we need to understand the business financials and what that looks like today. We also need to understand what the management team independence looks like. We have to understand what the seller motivation, and the seller could be any of the shareholders that wants to get out, and what their timeline is and how long they could potentially wait. We have to understand current debt loads and really what do those ratios look like? And then what has the trend been? Because the best time to start looking at this is whenever the company is consistently growing. And I hear a lot that, well, why would I sell or why would I try to get liquidity? Because next year is going to be even better. That is the best time. If it starts going the other way, no one wants to talk to you any longer. And that is a reality that I think everyone just needs to recognize. And that goes perfectly into the opportunity cost. Omni, you want to talk a little bit about that?
Yeah, I mean, the idea of doing nothing is always an option, okay? But it's not a neutral one. There's an opportunity cost involved with this. There's obviously those costs. There's the tax costs, trying to wait for a better tax environment. That's speculation. The current window that we have may be as good as it's going to get, anytime in the near future. We talked about valuation risk. Market multiples change. Sector-specific risk, they can compress valuations quickly and unpredictably. And again, those of you that have been in business for long enough know that you've had these challenges throughout your business life cycle. There's the concentration risk that compounds. And that's something that, the longer your personal wealth remains concentrated in the business, the greater the exposure is to a catastrophic event. It's just the reality of it. It's also the way to make the greatest amount of wealth. So we understand that there is the possibility there, but it is clearly an opportunity cost potentially. And when we look at that, one of the things we have found that business owners do not do is they don't really evaluate the rate of return on their investment in their concentrated position. They don't really look at what my return is on my business as you would a return on any other type of business. And unfortunately, especially for multi-generational families, there's too much to unpack to even bother with that, but that's a real issue. And you need to be able to, again, bring structure and design so that you know these answers, because that can inform much better decisions. So the optionality cost is there. And you need to develop these roadmaps, and you need to, what we call, architect and design before these things happen. And once you design these things before they happen, then when they start to happen, you've already got the clarity, you've already got the understanding, and you've got an action plan that's been sitting on the shelf, it's everybody's vetted, everybody's on board with, and then you can move through this. And now the opportunity cost no longer becomes a drag on you. There's also the reinvestment decision, because once you've got the liquidity portion, what are you going to do with the money? afterwards. And that's also a part that's really challenging for business owners. As business owners, we control, and we love the control, and we know what we can do, push this button, do this kind of thing. If all of a sudden we have to now turn to the public markets and deal with the volatility that exists within the public markets, if we don't have a structure to be able to tame those, then we've got these reinvestment issues that we have to be looking at. So what's that expected return on the capital inside the business? What's the after-tax risk-adjusted return on a diversified asset portfolio? And again, coming back, which scenario better supports the long-term goals of what the family, yourself, the business, and the ownership is interested in?
So in closing, here's some core themes that we talked about. So liquidity timing is a discipline. It's a habit. It's a strategy that you can build into your business and into your family today. The option spectrum is wider than most owners realize, and it's wider than even what I mentioned today. There are so many other things out there that exist. Doing nothing has a cost. You should name it, quantify it, and then decide intentionally if doing nothing is the right option. The best time to prepare for liquidity is, this shouldn't come as a surprise, it's long before you need it. And every family business owner deserves a personalized liquidity roadmap. It's not a generic answer. And that might be an unpopular opinion because some of you have total and full control, and there are minority owners that are just a pain in your side. And I've talked to a lot of you about that situation. But the more that you can understand why someone needs the liquidity or wants it, then you can start solving the problems together. You're sitting on the same side of the table and you're working towards a common problem. And that, in our experience, has always worked out well. So thank you everyone so much for the time today. And David, if we have any questions, I think I left you with 3 minutes.
We do. And this one relates to what you were just talking about. What if there's a branch of the family that doesn't want liquidity? Now, the situation is, have you ever had a situation where the operating branch of the family wants to buy out other stakeholder branches who are non-operating?
All the time.
What do you suggest when the stakeholder branches who don't work in the business are feeling bullied to be bought out?
I think that first they own the stake. They can't be forced necessarily into anything. So if you want to buy them out on your own and you want to entice them to do that, then I would be prepared to pay a pretty nice premium to get them out. However, if they don't want out, then there's a deeper conversation that I think has to happen in terms of what does the entire owner strategy and ownership group want to do with the business. Clearly, they still want to be in it, so, which in my mind would be a pretty big vote of confidence to the existing owners. But my guess is the existing owners are saying we're the one, or the existing operators, they're the ones growing the value, and they're looking at this and saying, I'm the one driving value. Shouldn't I get more than the equal share that mom or dad left us? And it's a constant challenge. I mean, I know for our family, for Ami and I, like my brother and sister know that there is a floor of which they share in because they were born into this family. But they know also that unless they are working in the business, growing it with me, I get everything above the floor. And that has helped with that aspect of it. But it's a challenging situation, and I think it really takes communication more than anything else.
And it's there, and you have to be able to have those difficult conversations. And remember, everyone has their price. So premium, you want to pay a premium? I can assure you, you'll find somebody and you'll be able to get out. But that's not always the best answer.
Right. Indeed. Well, we are coming up at the half-hour mark, so I'd just like to thank both of you for yet again another succinct and insightful session on liquidity. There are 3 more following this, so make sure that you sign up for those when the notifications come out. And I would love to have you all join us next month for Family Business Legacy, which is at the University Club in Chicago. Brian and Ami and colleagues will be there to continue this kind of conversation. And legacy is the type of event where you think about what's next. So just take a scan of that QR code, register today, and we'll see you in Chicago. With that, Ami, Brian, thank you so much for a wonderful session. And to all of you, I wish you a wonderful weekend, and we'll see you at the next session. Thanks.